Mahesh Nandurkar joins us. Mahesh, good morning. Thank you for joining us. What is the first reaction you got from your clients and from your investor base when you, in a sense, shared your budget take with them? Are they happy? Are they excited? Do you think the budget has ticked all the boxes?
Yeah, hi, good morning, Nikunj. Uh, yeah, so the thing is, I would say that in general, over a period of time, from the market standpoint, budget has become, less big of an event, and rightly so, and that's how it should be. I mean, we don't want to see a budget creating market volatility all the time. Obviously, it has some stock specific impact as such, but yeah, but by and large, I would say that I think it's quite well received the fact that the government has resisted the temptation to go populist in a pre-election year, had stayed the course very much on fiscal deficit reduction. The borrowing program appears reasonable. The government assumptions on revenue etc. appear to be quite reasonable. And the most positive and the biggest positive surprise has been the big focus on the capex growth of 24% on an adjusted basis. That's a pretty robust number to look at. So yes, I would say that given the tight situation that we have been in, I think it's a budget that has been quite well balanced, and yes, has ticked the boxes in terms of what could have been done. Obviously, it is coming at the cost of something else. I mean, you cannot have fiscal consolidation, you cannot have 24% capex growth without costing you anything, and the cost is that the non-capex part of the government expenditure has grown by only 2% on a YY basis, which will probably be a sentimental dampener for those expecting a big rural push, etc.
There is one standout loser, and that's the insurance sector. So, as an institutional research brokerage firm, what is your view on the Indian insurance sector going forward, considering that India is now moving into a new tax regime, and we know that insurance, in a sense, historically has been an instrument of choice for tax savers also, and going forward, that will change.
Yeah, see, the thing is, over a period of time, what we have seen the government doing gradually, step by step, is reducing the tax incentives and reducing the number of instruments and the number of choices that you have to kind of, manage your personal tax rates. And I think what has happened in insurance is one more step in that direction. I mean, if you recall, it started off with basically the change in definition of long-term in case of debt securities. Then there was some short-term capital gains tax on equities and some long-term capital gains tax on equities and so on. So my sense is that this is a step in that direction, and to the extent that the finance minister has also compensated a little bit by reducing tax rate at the bottom end, but at the top end as well. So I think these are compensating factor from a broader perspective. For insurance companies, yes, these high ticket investment oriented items were about 10 to 20% of the total APE for different companies. So there is going to be some hit, on that. Although we are still awaiting other clarification in terms of, even if those, the returns from the high ticket investments become taxable, whether they're eligible for the usual indexation benefit, etc., or not. But having said that, yes, there's going to be that impact on the, one-time impact, on the insurance growth. And I think to some extent the stock prices are reflecting that. But I feel that it's more like a one-time impact. I don't think it really changes the trajectory of the growth of the insurance market per se.
Mahesh, I'm going to just move a little bit outside the ambit of the budget and talk about what's really happening in the current market environment and all the news flow around the Adani Group now that the FPO last night was called back. You think it's an event which is of global interest and in that sense sort of an image builder for India this way or that?
See, the way I look at it from the stock market point of view is that the group has come out with some clarification in terms of the exposure to the various the state owned banking system, the private banking system. LIC has come out with its own disclosures. Some of the other banks have come up with their own disclosures as well. So the way I look at it is that it's not really a systemic risk for the Indian banking system or the Indian financial system, so to speak. Uh, so so the way I look at it is that I mean it's basically should not be viewed as a risk for the system as a whole.
Yeah, absolutely. That's not at all what I was meaning. But tell me, getting back to the budget then, Mahesh, just wanted to understand. I can see that in your notes you've talked about as to how the budget clearly stands to benefit the rural plays. So those companies do good because of the capex push. There is going to be the infra theme, which the market already has caught on and continues to favor as well. If you were to draw an analogy in terms of stock market sectors and stocks which stand to benefit or become even dearer after the budget, what's the list like?
I think clearly there are two very clear beneficiaries according to me. One is obviously the capex related plays, um, with an obvious push coming from the central government, which was more or better than what we were expecting. And I also want to highlight that which is that outside the central government budget, but I believe that going forward in FY24 and beyond, the other two segments of the capex driver, which is the state governments and also the private sector, are also likely to pick up. Uh, Over the last couple of years, the state government have been dragging their capex spends, but now the fiscal deficit and the debt to GDP ratio for the state governments is very close to the pre-pandemic level. Basically, the fiscal deficit is back to pre-pandemic level. The debt to GDP ratio is slightly higher, but not way higher. So I think that paves the way for the states to actually up the capex game, going forward. And we are seeing some initial signs of the private sector capex also building up. So my sense is that in addition to the central government effort, there are these other two drivers as well, which actually makes the scenario quite optimistic for investment related plays, and particularly the contracting and the capex and the infra sector plays as such. So that's clearly one beneficiary. The second beneficiary is also the tobacco stocks, because the tax increase has been quite modest. And my sense is that given the fact that we are now out of the purview of the
Right.
GST compensation bit, which means that the next tax
Right.
event for tobacco is probably now 16 months away. So that's the second big beneficiary.
A 16% duty hike is what we saw on tobacco, the sin duty hike, as it's called, making a comeback after nearly 3 years. And you did see the from ITC to Godfrey Phillips being punished in trade. Very quickly, Mahesh, before we let you go, any word when it comes, you've spoken about the public sector banks with respect to Adani. Now, we tried from the DPM secretary yesterday, really, really hard to figure out what could happen with the smaller banks, if they could be up for disinvestment, strategic sales, privatization. We couldn't get much from that interview, but what is it that you folks in the markets are expecting? Just seen the recent share run up.
Okay, just because that I want to clarify on the previous point on the tobacco taxation. See, 16% increase in NCCD, and NCCD itself is only 10% of the total tobacco taxation. So effectively, we're talking about only 2 to 3% increase in the tobacco taxation, which is actually quite a positive development from my perspective. So therefore, I just want to make that point clear that tobacco taxation has been quite benign. So that should be seen quite favorably, according to me. To your other point on the state-owned banks, I think the state-owned banks, valuations, are looking pretty attractive. I mean, it was attractive. It has gotten better over the last few days. And yes, there have been some concerns, on the asset quality, as such. But my sense, as I mentioned in one of the previous answers as well, that I don't think we are going to get into any NPL cycle, so to speak. And the credit growth outlook looks pretty reasonable. 14-15% should be the number to be looking forward to. And I continue to believe that the provisioning costs will continue to trend down. So I would say some of the larger state-owned banks appear to be quite interesting bet at this point in time.
Right. Mahesh, great to have you on the show today. Thanks as always for taking the time out.